Folks, this year is going to be one of the most opportune in stock market history. And in today's video, we're going to break down the top 5 stocks that I consider must buys right now in January 2026. These are all going to be stocks that you're going to see people talking about all year. And in many cases, I think these are going to move extreme percentage points up. Each of these stocks has a clear case for massive upside in the first half of 2026, has very beautiful catalysts at play, and or lined up, has long-term proof of concept and or powerful backing, in many cases backed by the US government. I'm going to make a detailed case for each of these, and I'll let you be the judge. And as always, if you're the one taking the ultimate risk, you got to be the one doing the ultimate risk. Always do your own due diligence on all ideas presented. As we begin 2026, understanding the macro setup is absolutely critical. Without grasping these fundamental themes, you risk being completely blindsided while certain sectors explode and others collapse. Let me walk you through the 5 major themes that will define this year's market landscape. The first theme is dollar destruction. The United States is currently carrying $38 trillion in debt. To put this in perspective, back in 2000, that number was 5.6 trillion. By 2008, it had climbed to 10 trillion. In 2020, we hit 27 trillion. Now we're sitting at 38 trillion. As discussed in previous analyses, there are only 3 possible solutions to this crisis. Austerity, which simply isn't happening. Default, which also isn't happening. Or the third option, inflate away the debt. That's exactly what's occurring right now. Sophisticated investors recognize this reality. That's precisely why gold just posted its strongest year-over-year return since 1979. Silver is now playing catch-up with an aggressive melt-up pattern. Even with many money managers expressing concerns about valuations, stocks continue their relentless climb. Assets are absorbing massive buy orders because capital is fleeing the dollar at an accelerating pace. The bottom line is straightforward. The US dollar will continue losing purchasing power, and real assets, solid tangible assets, will continue appreciating. The second theme involves Venezuela as an inflation cheat code. The United States has captured Nicolas Maduro and is signaling a comprehensive rebuilding of Venezuela's oil infrastructure. This isn't primarily about oil company profits. This is actually about breaking OPEC's pricing power and providing the United States with a mechanism to print money without triggering runaway inflation. Venezuela possesses 303 billion barrels of oil, the largest reserves on the planet. Production collapsed from 3.5 million barrels per day down to under 900,000 barrels per day under socialist mismanagement. If US companies can rebuild production to 2 or 3 million barrels per day, that represents 1 to 2 million barrels of new supply controlled by American companies, not OPEC. Regardless of your political views on what happened with Venezuela, the opening of their supply represents a significant challenge to OPEC's dominance. OPEC's entire business model depends on restricting supply to maintain elevated prices, but cartels only function when they control sufficient market share. Venezuela coming under US influence fundamentally breaks that dynamic. How does this impact inflation? Consider the strategic chess game being played. By controlling Venezuelan oil, you suppress energy prices, which in turn keeps CPI subdued, which means you can print more dollars to inflate away that 38 trillion in debt. Simultaneously, the general population doesn't revolt because inflation appears controlled. This isn't just about securing oil supply. It's about securing the ability to continue inflating the US dollar without the typical consequences. Everyday goods might see modest inflation, but assets will melt up regardless. This has been the American playbook for 100 years. Because many countries were attempting to pivot away from the dollar and actively dumping dollar holdings, the US was losing this capability. Venezuela represents a key chess piece to restore this dynamic. The third theme is the geopolitical tinderbox. Venezuela isn't the only flashpoint. Iran remains at a boiling point with continued tensions. The nuclear situation from 2025 hasn't been resolved. Defense stocks are pricing in continued conflict. Prediction markets are pricing in continued conflict. Then there's Greenland. The administration wants it because of massive rare earth deposits and Arctic shipping lanes. This is about strategic resources, not real estate. The strategic materials Greenland possesses are the real prize. China and Taiwan represent another flashpoint where the US is helping stockpile weapons and accelerate drone production throughout the region. Whether actual conflict materializes or not, preparation is driving billions in spending. This could mirror Ukraine, where there aren't boots on the ground, but there's massive military production and money printing funding a proxy conflict. Wars are inflationary. Preparation for wars is inflationary. Cold wars are inflationary. Before we dive deeper into specific opportunities, if you're finding this analysis valuable and want to stay ahead of these massive market shifts, make sure you're subscribed to Next Stock Path. We're breaking down these complex themes into actionable insights you can use. Hit that subscribe button now so you don't miss what's coming next. The fourth theme is the AI power crisis. Over the past couple years, investors bought AI stocks primarily because of excitement around productivity gains and revenue potential. Right now, the biggest barrier for AI isn't algorithms or talent, it's power. AI data centers consume extraordinary amounts of electricity. Whoever controls the most power will have the best AI, and whoever has the best AI will be the future superpower. Expect massive investment to flow into this sector. The number one power source for AI and the AI grid is nuclear energy. If last year was about developing AI, this year will be about powering AI. That's a major investment theme. The fifth theme is American state capitalism. The government is no longer simply regulating companies, it's entering the free market and actively backing specific players. Whether we're discussing rare earths, semiconductors, nuclear energy, defense, or tariffs, the government is picking winners and losers. This isn't your grandfather's free market anymore. The government has determined that certain industries are strategically vital and is putting its full weight behind them. When you combine all five themes, what do you have for 2026? Dollar destruction, Venezuela as the inflation cheat code, a geopolitical tinderbox, an AI power crisis, and American state capitalism with government backing of strategic industries. Every single investment opportunity I'm presenting directly relates to one or more of these themes. My goal is to position you at the forefront of what's coming, because those who aren't positioned will unfortunately get left behind. Let's start with the fifth opportunity, Chevron. Bloomberg reported this morning that Chevron is lining up 11 oil ships as Venezuela's dark fleet vanishes. As we've discussed, the United States is preparing to completely open Venezuela and rebuild its oil infrastructure. The administration has stated this won't happen with public money, but with private companies. Who's been sitting in Venezuela for decades waiting for this opportunity? Chevron, they're the only major U.S. oil company currently operating in Venezuela and are positioned to dominate as the U.S. forces are reopening. Before the Maduro capture, they were already producing roughly 17% of Venezuela's entire output. They already have the relationships, the assets, the institutional knowledge, and most importantly, first mover advantage on what could become the biggest oil reconstruction project in history. This represents a massive tailwind for Chevron, and they don't have to execute alone. They just need to be the tip of the spear, and right now they are. The first catalyst is Q4 earnings on January 30th. Management will provide clarity on Venezuela licensing, the Hess acquisition integration, and capital allocation. Wall Street will be laser focused on Venezuela commentary. Analysts have price targets ranging from $162 to $178, and these targets were established before the Venezuela development. Analysts see meaningful upside even without a Venezuela windfall. The second catalyst is Guyana, their other growth engine. Chevron has offshore production ramping with Exxon that diversifies them beyond Venezuela. Management is targeting over 10% annual free cash flow growth through 2030. Even if Venezuela takes longer than expected, Guyana is firing on all cylinders. The third catalyst is the Venezuela rebuild itself. If the US provides full sanctions relief and there's an orderly power transition, Venezuela could add several 100,000 barrels per day of production over the next 12 months. Chevron is the only major player with boots on the ground. What about risks? This is a long-term play. Venezuela's infrastructure is devastated. We're discussing years of rebuilding. Oil prices remain volatile, and there's always the possibility that political stability doesn't materialize as hoped. But here's my analysis. If you believe American companies will redevelop Venezuela's oil resources, and that seems like a safe assumption given recent events, Chevron is the most direct way to play it, period. The fourth opportunity is SLV, iShares Silver Trust. This ETF tracks the spot price of silver. There are multiple ways to gain silver exposure. If you're buying physical silver, consider actual bars. But for trading, SLV offers excellent liquidity in both the stock and options markets. Silver is a massively scarce resource currently melting up, especially relative to the US dollar. Silver is used in solar panels, electric vehicles, military equipment, and AI data center hardware. Silver is literally the best conductor of electricity on planet Earth. When you need to move electrons efficiently, silver is unmatched. But here's the problem. The world isn't mining enough. The silver market has been running a structural deficit of 160 to 200 million ounces annually. We're consuming more silver than we're extracting. London and Shanghai inventories are at multi-year lows. ETF inflows hit 130 million ounces in 2025 alone, with holdings now at 844 million ounces, up 18%. Countries like China are threatening and implementing silver export restrictions, putting the US in even greater shortage. Layer the dollar destruction theme on top of this. The US has 38 trillion in debt. The Fed is cutting rates. Powell will be replaced in May. All of this creates massive tailwinds for hard assets like silver. If you look at gold's performance, silver has considerably more room to run. The gold-silver ratio has already narrowed from 104 to 1 down to 64 to 1. Bull case targets for silver range from $100 to $175 per ounce. We're currently bouncing around $60 to $70. That represents potentially 50 to 160% upside if analyst targets hit. I actually believe silver can go much higher because it's been suppressed for the last 30 to 40 years. You can watch previous analyses for detailed explanations of that suppression mechanism. Silver was added to the U.S. critical minerals list in 2025. The government now considers it strategically important, which is core to understanding why silver is compelling right now. If you believe the dollar is being systematically devalued, which I do, and if you believe industrial demand for silver is structural, which I do, then SLV allows you to play both themes simultaneously. In terms of risk, when the Fed eventually reverses course and hikes rates again, hard assets will cool off. But if you examine history, long-term, the dollar will continue being inflated. You'll continue seeing trillions of new dollars entering the system, which means hard assets like silver, while experiencing short-term pullbacks, will melt up long-term. Don't believe me? Look at the last 100 years. Ask yourself if government is suddenly more disciplined with money. Of course not. If anything, it's worse. The third opportunity is Kratos Defense. Kratos isn't your grandfather's defense contractor. They're not building aircraft carriers or $100 million fighter jets. They're building the weapons of tomorrow, and the military just made it official. The future of warfare is autonomous, cheap, mass-produced, and designed to be expendable. Why would you send a $150 million F-35 into contested airspace when you could send 15 drones costing $10 million each with no pilots? If you lose one, who cares? You have 14 more. This is called attritable warfare, and Kratos is the leader. Their flagship product is the XQ-58 Valkyrie, a high subsonic jet drone designed as a loyal wingman for manned fighters. It can fly alongside an F-35, carry weapons, jam enemy radar, and absorb missiles that would otherwise hit the pilot. It's like having an expendable robotic bodyguard that can also engage. Here's the big news. The US Marine Corps just designated the Valkyrie as an official program of record. For those unfamiliar with Pentagon terminology, that's a massive deal. A program of record means recurring federal budget funding. It's not a one-off contract or pilot program. It's a line item in the defense budget funded year after year. It's extremely difficult to lose a Pentagon contract once you have it. Kratos expects to deliver 15 to 20 Valkyries in 2026. They've already won a $34.8 million contract from the Marines. There's a classified program called Poseidon worth up to $750 million ramping up in 2027 and 2028. Kratos' defense rocket systems business is exploding with 116% organic revenue growth in Q2 alone. They've secured 60 Zeus hypersonic motors from L3 Harris and are scaling production for the Navy and Missile Defense Agency. The Pentagon just signed a $900 billion plus NDAA. They launched the Replicator Initiative, aiming to deploy over 1,000 autonomous systems to counter China. Guess who's first to market with these drones? Kratos. They also just partnered with Airbus to develop a Valkyrie variant for the German Air Force by 2029. Europe is dramatically increasing defense spending post-Ukraine, opening an entirely new market. The stock has already run up approximately 190% in 2025. Market cap is now around $13 billion, but management is guiding for 15 to 20% organic growth in 2026 and another 18 to 23% in 2027. The multiples you could see if they secure additional massive government contracts and revenue materializes could be substantial. The risks include defense contract delays, budget reshuffles, and continuing resolutions. Timing in this industry is notoriously unpredictable. But right now, with current geopolitical dynamics, it's difficult to argue this won't be a major beneficiary. The second opportunity is NuScale Power, ticker SMR. This name is arguably the most risky and speculative on this list. We called it out in the pre-SPAC phase before its massive run. We predicted a significant take-profit cycle after the SPAC combination. It did exactly that, dropping massively. Now I see long-term value opportunity. You must understand the context. AI data centers are power hogs, consuming as much electricity as small cities, and they need that power 24/7, 365 days a year. Not when the sun shines, not when wind blows. Solar can't provide that. Wind can't provide that. Nuclear can. And NuScale is the only company in the USA with an NRC-approved small modular reactor design. The NRC, the Nuclear Regulatory Commission, is one of the slowest moving regulatory bodies on Earth. The entire process from design to approval took over a decade. That's a significant competitive moat. What's a small modular reactor? Think of it as a nuclear plant, but smaller and factory built. Instead of constructing a massive facility over 10 years, you build modules in a factory and ship them to the site. They're scalable, configurable in 4, 6, or 12 module setups, ranging from 308 to 924 megawatts. This is perfect for data centers. Amazon Amazon, Microsoft, and Google all need carbon-free, reliable baseload power. They're literally becoming their own utilities because they can't get enough clean electricity from the grid. NuScale just landed massive deals. Deal 1, RoPower in Romania, 6 reactors. Deal 2, Entra 1 and TVA. This is the big one. The Tennessee Valley Authority, the largest public power supplier in the USA, just signed an agreement with Entra 1 Energy to deploy up to 6 gigawatts of NuScale SMR capacity. That's enough to power 4.5 million homes or 60 data centers. This could be the largest SMR deployment in US history. Entra 1 is also positioned to receive up to $25 billion in investment capital under the new US-Japan Framework Agreement. The risks are real. Nuclear projects historically face massive cost overruns and timeline delays. The industry has a checkered past. There's always risk that these deals take longer than expected or regulatory issues emerge. However, with everything happening right now, the current administration's priorities, and how critical building nuclear energy capacity is to stay competitive on AI, I believe this will be a big winner in coming years. But it is speculative and far more so than other plays on this list. Nonetheless, it's one of our favorite plays for 2026. The number one opportunity is Vistra Corp, ticker VST. Vistra is an integrated power company operating across 18 states. They own 41 gigawatts of generation capacity, including nuclear, natural gas, solar, and battery storage. They serve about 5 million retail customers, providing substantial proof of concept. But here's what makes them special. They've transformed from a boring legacy utility spinoff into what you could call an AI power plant. Data centers need 24/7 reliable power. Guess who has it? Vistra. They own nuclear plants. They own natural gas plants. They own the infrastructure. Vistra just signed a 20-year power purchase agreement for 200 megawatts from their Comanche Peak nuclear plant in Texas. 20 years means locked-in revenue through 2045. Amazon, Microsoft, and Google are all circling these power companies because they literally cannot build data centers fast enough without securing electricity first. AI and data centers are projected to consume 8% of US power by 2030, up from just 3% today. That supply must come from somewhere, and Vistra is supplying it. Let's examine numbers. 2026 guidance is $6.8 to $7.66 billion in adjusted EBITDA. That's not revenue, that's EBITDA, a cash generation machine. S&P just upgraded them to investment grade in December 2025. That's significant, lowering their cost of capital and signaling that rating agencies see them as financially stable. Here's the kicker. 96% of their 2026 generation is already hedged. That means revenue is basically locked in. In terms of risk, power prices do fluctuate. Nuclear operations face potential regulatory issues, but VST is a bet on something already working. This is arguably the most built-out play in the space. The data center demand is here, contracts are signed, EBITDA is growing, hedges are in place, and they've got nuclear and gas capacity that hyperscalers need. I believe they'll continue receiving more capital. If NuScale is building the nuclear future, and we're bullish on that, Vistra is monetizing the nuclear present. These 5 opportunities directly align with the major themes defining 2026. Position yourself accordingly, stay informed, and remember to subscribe to Next Stock Path for ongoing analysis as these themes develop throughout the year.